Well, these are extremely interesting times to say the least. We're sitting here at the end of 2025 in the midst of a government shutdown, which provides no data to allow us to assess how well the economy's doing, what unemployment might be, what job growth might be. We don't know what personal spending levels are. Retail sales are not being released. So it's very difficult to determine what the impact of the tariffs that have been executed, the monetary policy changes that the Fed is executing, and the fiscal policy changes of a new tax bill, immigration reform, lack of workers coming in to fill those jobs. We just have no way of knowing what that impact is as yet. So without that data, it becomes very difficult for policy setters and even more difficult for forecasters to try to come up with a reasonable expectation about what the future holds. If we start with where was the economy before the shutdown and before the absence of data, you'd conclude that consumer spending is holding up well. You conclude that the consumer is still willing to buy, that incomes are growing, and that there's no reason to believe that we're about to go into recession. That will all be tested over the course of the last couple of months of this year and into the first quarter of next year, as we finally get data that indicates one way or the other the exact impact that all these uncertainties have. We certainly expect the Fed to err on the side of caution by being stimulative and lowering managed interest rates in order to ensure that we don't see a significant increase in the unemployment rate. One of the strengths in the economy continues to be construction building, a lot of it commercial, but we're also seeing a shift in housing construction with a lot of villas and zero lot line projects going in on any vacant land. We continue to think there's a housing shortage in this country and that we will continue to have to find ways to build adequate housing for more and more people. Commercial construction is going to benefit from the tariffs as companies shift production back from foreign sources and produce product here in the United States to avoid the cost of paying tariffs to import those goods. So we think that leads to continued active commercial construction activity, added to the location in Northwest Ohio of the intersection of major north-south, east-west expressways, railroads, seaport, airport. We think that this is ideally located for being a beneficiary of the expansion of commercial building. We also have water resources and at this point the electric resources necessary to accommodate significant growth in commercial activity. I think the big opportunity has got to be in artificial intelligence. AI is just at the early stages of being able to be implemented by a variety of industries in the economy, realizing significant benefits and reduction of costs, which will allow them to be price competitive with product and services as a result of that. As companies actively explore the ways that AI can effectively help that company manage growth while keeping costs at lower levels. So I'm excited about the changes that will occur to the U.S. economy as companies implement and execute the efficiencies that can come from AI. The ag sector is being buffeted right now because it's caught in the middle of a lot of the tariff discussions, certainly the most visible being soybeans and the lack of the ability to sell into the Chinese market, which had been a huge purchaser. And it, to the degree that ag products become a pawn in the diplomacy of tariffs, it's certainly going to impact prices. Additionally, we've had some severe weather situations across the country, including Northwest Ohio, where we're in the midst of a drought. And that's going to impact us in terms of yields next year more than this year. So we see the opportunity for ag prices to do much better next year with yields down and inventory carryovers at lower levels. So I think there's a good chance that while in the short run, farmers may need financing to get through this transition, that in a longer term basis, it leads to stronger financial performance on the part of ag producers. Certainly the Federal Reserve continues to be more concerned with the possibility of an unexpected rise in the unemployment rate as the economy is affected by tariffs and by other uncertainties. That means that they will continue to lower interest rates in an effort to stimulate the economy. The Fed has repeatedly said that they want to get to neutral with their monetary policy position, where monetary policy is neither stimulative nor restrictive. Most people would define that level as a Fed funds rate of 3%. Currently, the Fed funds rate is 4.25%. So we see the probability the Fed will continue to lower interest rates until they get to neutral, around the neutral level, unless, of course, we finally get some economic data with the government reopening indicating either a need to go faster than that or to slow down. But at this point, we expect them to continue to lower interest rates all through the first half of 2026. I certainly think that consumer incomes and consumer balance sheets are in strong enough position right now to believe that we will not see a recession in 2026, that economic growth will certainly slow in maybe the fourth quarter and first quarter of next year, but that in the last 3 quarters of 2026, we will see solid real GDP growth above 2%, and that the likelihood of a recession becomes relatively remote, given the expectation that incomes will rise and consumers will continue to increase final demand.